Most people are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. This is getting to be so serious that we are reaching a cathartic moment, and I do think it's started.
The star stock picker and founder of $60 billion ARK Invest, Cathie Wood, warns that the Federal Reserve's impending tightening will have disastrous effects on the economy. She acknowledged that she had miscalculated the impact and persistence of inflation, which the United States is already experiencing. What's really happening? As inflation rose to 40-year highs and the Federal Reserve engaged in the most aggressive rate hiking pace in generations, Wood has been among the most well-known investors who have found themselves on the wrong side of increasing interest rates. The cost of borrowing has increased, which has had a negative impact on the type of innovative growth firms that Wood focuses on and which are frequently unprofitable. The recession has already begun, but the upcoming situation is worse than that, she warns. According to Wood, in comparison to the 1980s, when previous Federal Reserve Chair Paul Volcker increased the Fed funds rate from 10% to 20% to combat inflation, the prevailing monetary policy in the United States in September was noticeably more restrictive. Jeremy Powell and his staff, in contrast, have raised it 13-fold from 0.25% to 3.25% in order to slay the dragon. When this Fed began to address the current spike, inflation had been simmering for about 15 months, not 15 years. It is currently staying at it with a sledgehammer that is 13 times stronger than the one Volcker used in the 1980s. Wood also notes that although Treasury yields increased 1.6 times from 10% to 16% under Volcker, they increased a staggering 7.4 times under Powell. Risk aversion is pummeling all assets except cash, but the Fed seems fixated on hiking rates another 100+ basis points to protect its legacy. The extreme tightening in yields, which was inconsistent even with a rising interest rate environment, was what Wood seemed to emphasize. Interest rate increases typically cause bond markets to go through a rough patch, but this recent spike in yields is severely hurting the fixed income sector. Meanwhile, commodity prices, as measured by Refinitiv's CRB index, have dropped 42% since their peak in mid-2008, 25% since their lower peak in 2011, and 19% since an even lower peak earlier this year. Her remarks came amid a slaughter in the stock and commodities market around the world, which was brought on by the Federal Reserve's impulsive rate hikes and forecasts. In the previous 6 months, the Nasdaq index lost close to 25% of its value. The parabolic rise of the dollar has been disastrous for the rest of the globe and should have a negative impact on the competitiveness, employment, and economic activities of the United States, pushing the Fed to change course. The Federal Reserve is disregarding signs of economic deflation. According to Wood, its ruthless rate hikes may be driving the economy into a situation akin to the Great Depression. The situation resembles the Roaring Twenties of a century ago, and deflationary indications are already very strong. Prior to the Roaring Twenties, the world was at war, World War I, and suffering a pandemic, Spanish flu. While both had more serious impact on the global economy, today's combination is a strong echo that could result in much lower expected inflation and a boom in innovation. Wood notes that the telephone, electricity, and the internal combustion engine were among the many general-purpose technologies that were developed simultaneously in the 1920s. If inflation is unwinding, as we believe, then we could be heading back to the future, the Roaring Twenties, the last time several general-purpose technologies evolved at the same time: telephone, electricity, and the internal combustion engine. The setup is remarkably similar. 1920 had over 20% inflation due to the supply chain problems brought on by World War I and the Spanish flu. In retaliation, the Fed swiftly increased the interest rates from 4.6% to 7% in just 1 year. The rate of inflation fell to -15% in 1921. Based on this example, Wood is not excluding the possibility of annual inflation going negative in 2023 as the Fed continues to pursue its hawkish monetary policy position, which Wood called a catastrophic error. She claims that we shouldn't be shocked if general inflation starts to decline in 2023. From 4.6% to 7%, the Fed's interest rate increase in 1919 and 1920 was less than a doubling. This time around, inflation was significantly lower, so the Fed boosted interest rates 16-fold, which is, in her opinion, a severe error. The Fed's actions will determine whether or not we get to experience the Roaring Twenties once more. If inflation falls below the Fed's 2% target and economic growth disappoints, interest rates are likely to surprise on the low side of expectations next year, ushering in this century's iteration of the Roaring Twenties. The Fed reduced interest rates from 7% to 4% in the 14-month period after inflation fell to a negative 15% level in June 1921. The switch was tripped for the Roaring Twenties by this. Wood cautioned that with the Fed now fully committed to combating inflation, a Fed turn in 2023 might not take place, which might result in a situation akin to the Great Depression. She observes the scenario will be more like 1929 if the Fed does not change its course. When Congress passed Smoot-Hawley in 1930, it imposed 50% plus tariffs on more than 20,000 items, sending the world economy into the Great Depression. The Fed had hiked rates in 1929 to quell financial speculation. As all members of the Fed are voting unanimously, there hasn't been any debate among Fed officials over their present monetary policy agenda, indicating that the US central bank has so far ignored deflationary signs. Deflationary signs are being ignored by the Fed, and the CHIPS Act may have a greater impact on trade than we realized. Economists have not given much thought to the prospective effects of the CHIPS Act, similar to how they did with Smoot-Hawley. The Consumer Sentiment Survey at the University of Michigan is at a historic low, below levels achieved in 2008 to 2009 and 1979 to 1982. A setup for a liquidity trap like that in the Great Depression when enormous monetary stimulus failed. On August 9, 2022, the CHIPS and Science Act was enacted into law. $280 billion will be invested with the intention of enhancing national security, innovation, and competitiveness in the United States. The industries being targeted include domestic semiconductor production, quantum computing, artificial intelligence, clean energy, and nanotechnology. Wood is not the only pro-deflation advocate. The CEO of DoubleLine, Jeffrey Gundlach, recently said that the danger of deflation is considerably higher now than it has been over the past 2 years. Goldman Sachs also decreased its forecast for inflation over the weekend, stating that it anticipates a substantial decline in pricing pressures in the United States in 2023. The bank noted a peak in housing inflation, slower wage growth, and a resolution of supply chain problems. The Fed's preferred gauge of inflation, core personal consumption expenditure, is predicted to decline to 2.9% by December 2023 in the Fed's latest projection. At the moment, the core personal consumption expenditure stands at 5.1%. Wood notes the falling price of energy, such as the most recent dip in oil prices, minus 1.01%, and copper, minus 8.6%. She asserts that as firms attempt to get rid of it, blown up stockpiles at enterprises should result in cheaper costs over the coming few months. A further indication of the inventory overhang out there that companies are attempting to fix right now, according to Wood, is the recent decline in the e-commerce focused Adobe Digital Price Index. Deflationary indications are coming down the pipeline, starting with commodities. Retailers are drowning in inventory at the consumer level, where the pipeline ends. Nike is the most recent and controversial. Nike primarily sells to other retailers, and its stock levels rose by 44%. The consumer was already exhibiting warning symptoms of deterioration. Its stockpiles in North America increased by 68%. The amount of inventory in transit, primarily from Asia, increased by 85%. Nike will need to lower prices, and merchants will too, in order to get their products off the shelves. Coming to bonds, this time they are depreciating against equities, and the freeze in liquidity is one of the causes. Those who are dealing with margin calls or other financial difficulties will sell their most liquid asset if they have no other option. Wood believes that because government bonds are typically the most liquid asset, we are still witnessing a surge in government bond prices despite all of the deflationary warnings coming down the pipe. Currently, it appears like we are approaching a cathartic moment, which will cause certain financial signals that the Fed will need to pay attention to. In Wood's opinion, the guilt trip may not have required your attention, but it is the reason that the near Lehman catastrophe occurred in the UK. Therefore, you should have. The turnaround is almost complete, and there is a hope that the Fed moves away from the demand for consensus and a united front, when in reality, there is plenty of room for disagreement among all those Fed members and presidents. Wood believes that this debate is being suppressed. Data ought to be the driving force behind the discussion, but this is impossible because then everyone would not now hold the same opinion.